Hey, what's up, everybody? So today on Real Estate Fundamentals, we're going to do something a little bit different. So I've actually printed an email here. This is an email from a private lender. This is a first-time private lender a few months ago. I helped her analyze a deal that she was considering lending on. It was her first deal. So she reached out. She read my book, quick plug, Private Lender Playbook. If you're a private lender and you're wanting to learn more about the steps of becoming a private lender, safeguarding yourself, how to analyze a deal, how to analyze a borrower, check out my book. It's on Amazon, or you can go to privatelenderplaybook.com. So something else that I also do that I do on occasion is help private lenders analyze deals. So this individual reached out, like I said, I guess late last year, and helped me to analyze a deal and to lend on. So I did that. So I'm going to read her question and then I'm going to give a response. So it said, "Hello, Brant. You evaluated my first lending deal and it went very well. So thanks for that!" Exclamation point. I purchased your private lender playbook audio version. It's on Audible too. I purchased your private lender playbook audio version prior to consulting with you on my first deal, and it was so helpful. Another exclamation point. And I've been watching some of your recent YouTube postings to self-educate, but I haven't been able to quite find the answer to my question yet, and I'm hoping you can advise. Do you have some sort of guide that helps determine the amount of interest to charge on the loan terms? I realize it's a personal matter between the private lender and the borrower, but are there some general guidelines published somewhere? For example, if I'm not interested in points and I just want to charge 12% interest payments only, what determines the 12% versus the 14%? Is it something like loan duration, short-term loan versus long-term loan, et cetera, et cetera? I have another deal coming up soon. I may require you to evaluate it. Thanks so much. So this is an excellent question that if you're a private lender, you should certainly be asking is, hey, how do I get the highest return on my investment, right, with the least amount of risk possible? So there's some supply and demand things going on here. There's some risk versus reward things going on. So I put a little whiteboard together. So here's what we're going to do. I'm going to bring up the whiteboard in just a second. But the first thing I want to say, for those of you watching this is something that I heard years ago, and I found it to be true. And it is this: it is that you can typically determine the credibility of your borrower by what they. Geez, I totally butchered it. I just totally butchered what I've heard but I've been saying for years. So you can typically tell the experience of the borrower by what they pay for their money. There we go. You can typically tell the experience of the borrower by what they pay for the money. So typically the more experienced borrowers, the more experience they have, the lower interest they pay. Vice versa. Newer investors, little to no experience, pay a higher interest. Okay, so this is what we're going to be talking about. This is crucial. This is not 100%, but it's pretty darn close. I've just found that to be true. For example, when I started out as an investor, I borrowed from hard money lenders, and when I first began borrowing private money, I always paid north of 12%, 12, 14, 15%. I think I even paid 16% one time. So I was very little experienced. So once again, you can tell the experience of the borrower by what they pay for their money. So if you have an investor, a borrower who's willing to pay 14, 15, 16% plus points, all that kind of stuff, they're probably not very experienced. So I'm not saying you don't lend to them. I'm saying that you need to formulate that into your calculations on what if you want to proceed with the deal, and what rate and return makes sense for the risk and for the investment that you're making. Okay, so I put together a little kind of like a supply and demand chart. Let's see if I can actually get this thing to come here in the page. All right, so all right, there we go. So this is interest rates going anywhere from 5%, and yes, we've actually borrowed at 5% before, all the way up to 15%. Okay, 5 to 15%. These are what I call the 3 Ds. These are what the three main things you should be looking at when you're going to loan to a borrower, to a real estate investor. I put the dude, the deal, and the dollars. And also dudettes. Okay, I'm not going to discriminate here. But you really, first and foremost, one of my lenders told me this a long time ago. They said, Brant, we all know that, in a real estate deal, the real estate is a security, but they said, we don't really view it that way. We view you, the borrower, as the real security, right? Because we all know that deals go sideways. It's a matter of how that dude is going to perform if something happens. What is their experience? What's their track record? How have they handled when deals have gone sideways in the past? So you really want to spend probably the most amount of your time analyzing the borrower. What is their experience? What is their credibility? What is their integrity? All those types of things are kind of hard to measure. You kind of got to do some due diligence on that. Number two is the deal. Typically, a high amount of rehab, short-term flip deals are typically deemed as higher risk. So they're gonna garner a higher rate of return. They're gonna be north. By the way, this is the 10% line, which is kind of the median, right in the middle area where we're going to see if you're going to go above or below that. But if it's a higher risk deal, it's a new construction deal, if it's a development type of deal, it's going to be higher, deemed as higher risk. If it's a, paint and carpet rental property, or it's already an occupied rental property that's stabilized, it doesn't need repairs, doesn't have any major thing going on, it's in a good market. These are things you need to be looking at, the micro and the macro market of the deal. And then the dollars. How much are you investing? A $50,000 loan is a lot, different ball game than a $500,000 loan. So you need to be looking at those three things. Of course, the terms, the length of the loan, just other terms, payment structures, all those types of things. Is the borrower bringing money to the table? So we start here with the baseline of 10%. 10% is like a good kind of, like I said, like a median range. And then you start adding in some of these things. So if there's things that are really compelling to you that you like about the borrower, you like about the deal, if you try to go too high, you may say, man, I really like this deal, I like this borrower. So if you try to go to 13, 14, or 15%, like I said, you can tell the experience of the borrower by what they pay for their money. They may have lenders want to loan to them at 10 and 8%. I'll tell you that our average these days is around 8%. So you got to really look at that. Okay, and you just have to make a decision, a business decision. So you add all these things together to figure out what rate and term you do want to agree upon. And I say this a lot, and just when I'm speaking and in the private lender playbook, is that private lending is relationship-based lending. Like I would say this a lot, it's a handshake agreement backed up by the proper documentation, title company, closing, real estate, note, deed of trust, all that type of stuff, insurance. You secure that investment. But it all starts with a handshake agreement. I love to quote Stephen Covey, right? Win-win or no deal. So my answer to this question is you want to arrive at a number where you feel happy, the borrower is happy, meaning they still have a profitable deal, no, their numbers work for them to move forward with the deal, and then you move forward. What is that exact number? I don't know. It all depends on that kind of convoluted formula, but I hope that still helps where you can find out, what is the best loan rate and terms for you. There's definitely, options for both of you. And the last thing I guess I'll say is this, as you mentioned points versus no points. Well, you just got to let the borrower know after you analyze everything, say, hey, this is what I would be happy with. If you say you want to loan to them because of whatever you find at 14% and 2 points, then that real estate investor has to go back to their spreadsheet and say, hey, does that work for me? What is my supply of other financing sources? And they'll also make a business decision. to move forward with you or not, or just to counter, say, hey, those numbers don't work for me. Can we do 12% 1 point or no points? Or would you give me 6 months with accrued interest? It just depends, once again, on the deal, on the dude, on the dollars, on the deal. You put all those together and you come up with a win-win agreement that you're both happy with, secured by the proper paperwork, notes, deeds of trust, insurance, title commitment, all of which you can learn in this book. Sorry, several shameless, selfish plugs in this video, but I hope you got a lot from this if you're a private lender or a borrower for that matter. Y'all take care.